Welcome back, everyone. Next, we have Ethema Health Corporation. It trades on the OTCQB under the symbol GRST, and together with its subsidiaries, operates in the behavioral healthcare space, specifically in the treatment of substance use disorders. Please welcome its CEO, Shawn E. Welcome to the conference today, Shawn.
Thanks, Anna. I'm happy to say that I'm attending the conference from beautiful Kentucky today. And
all right.
Just wanted to let everybody know I'm going to try and get through the presentation quickly because I'd like to take some questions today.
Perfect. Well, the floor is yours. Call me back when you're ready for questions.
All right, Anna, thanks. So as everyone may or may not know, we're in the addiction treatment business, and we will, again, focus on getting through this quickly because we've just completed a huge LOI to acquire a big facility in Kentucky, and we want to get to that very quickly. So normal disclaimer, if anyone was with us in February at the Emerging Growth Conference, we at that point set out our goals and what we wanted to do in the coming months. We are currently a 62-bed facility in West Palm Beach, and we were at that time and profitable and cash flow positive. So you would have heard that we wanted to grow to 500 beds by the end of 2025, that we wanted to raise $1.2 million in bridge financing. We wanted to acquire 25% of the ARIA subsidiary, which is our West Palm Beach facility that we did not own. We had a partner. And then we wanted to raise $5 million for further growth and acquisition. So since then until now, we did raise $3.1 million of the bridge financing. We did acquire the 25% of the operating facility that we did not own. We did do some acquisitions and growth. We added 23-bed facility in Boca Raton, Florida. That facility is actually going to be opening tomorrow or Monday. And we signed just this last Friday, or the previous week, but we announced last Friday an LOI to add up to 440 beds in Kentucky, which is where I am today. We did, as part of the fundraising, we converted $2 million of debt to equity, and we're now going to raise $3 million instead of $5 million because the acquisition in Kentucky was done with full financing, and we'll get to that in a second. So I'm going to skip through this part here fairly quickly. We do have a long history in this business. We've been in it and had several treatment centers starting in 2011. There's currently 2 directors in the company, myself and Jerry Miller. We are looking to increase that board to 5, and we'll be looking for candidates to join our board. We do have a great advisory board that have been with us since the beginning. We do have incredible people in our Florida location. These are dedicated long-term employees of ours, great team. And so far from what I've met in Kentucky, an incredible team here as well. The market part of this is almost self-explanatory. Everybody knows the addiction treatment business and the addiction treatment or the addiction problem that we have. And you know, it's a huge market. It's about, I think, 48 billion now, about 17,000 treatment centers in the country. So a very, very large market. Lots of new things coming in addiction, especially the use of plant-based derivatives and psychedelics. Nothing legal yet, but when it happens, we certainly want to be at the forefront and be the first ones to participate in that with regard to treatment. Just a quick look at the properties. We have the facility in West Palm Beach is a 3-story building. Next to it is a 5-plex. We have both buildings side to side. They're right in downtown West Palm Beach, which is great for our clients. Great facility, great location. And this is a little bit of a shot of the interiors of the buildings. It's a very nice location. The facility that we're adding in Boca Raton, this is a picture of the building. It's actually a 3-story building. The lease that we've acquired is the first 2 floors of that building. The 3rd floor of that building is available to us, but we have not signed a lease on it yet. We still have yet to work with the landlord on that, but it is available. We expect to be adding that to our portfolio. the facility is set up and, ready to go. We did acquire this from another treatment center operator. We paid approximately $240,000 to acquire the leaseholds and the lease, but it was a turnkey facility that we were able to get licensed and get ready to open. And as I said earlier, we'll be opening tomorrow or Monday. The facilities in Kentucky, this is a couple of pictures. The top one was the original location that this company in Kentucky started with, and it's now a total of 14 owned properties and 4 leased properties with a total of 440 licensed beds, primarily in Moorhead, which is in the eastern part of Kentucky, and Paducah, which is in the western end of Kentucky, which is pretty critical, as I'll tell you in a moment. So quickly getting to the financial information, structure of the company, Ethema, our public company, is the head company. We do have the Ethema Health Center, which is our ARIA subsidiary in Florida. We have a separate billing company set up, which does billing just for us internally, and will eventually be doing the billing for Edgewater. In Edgewater Recovery Center, it would be the operating business for Kentucky, which we're adding. And then there's a couple of holding companies that own most of the real estate that the company occupies other than the leased properties, and that we'll be acquiring as well. So as I said, we're cash flow positive and profitable, EBITDA of just under $1 million the last couple of years in 2022 and 2023. Certainly expect bigger increases in that in 2024. Here's a recap of how we generate the revenue. This is a slide that shows that of the 3 locations that we have, the 2 in West Palm, which you can see under the total number is 52 and 10 beds. That's 62 beds. That's what we have right now. And 899 Meadows is the Boca Raton location. That's another 25 beds. That's opening in a day or two. Gets us to 87 beds. And at 60% capacity, which is the top line at the bottom, we get to $9.3 million in revenue, 3.3 in EBITDA. So we won't show that for the full year 2024, but on a run rate basis, we should be achieving those numbers in the next couple of months. If I add, sorry, just went. So if I take the next slide here, just the 4th line you see is 899 Meadows, floor 3. We expect to add mental health licensing to that bed, which is a little bit higher reimbursement rate and rounds out our offering in terms of what we can offer clients in the market. And again, you can see the gross margin under the last 3 lines on the slide at 60, 70, and 80% capacity. Dramatically increases on a percentage basis because we're leveraging all of our infrastructure in Florida to run these operations. So we get up to much higher gross margin rates. These are completely, at these capacities and our billing rates. These are real numbers. This is what we can achieve in revenue and EBITDA. So from 60% to 80%, you can see it's 13 million. 5 million EBITDA up to 17 and 9. This next slide is the adding Kentucky. This is just the Kentucky location. So in addition to the numbers that we just looked at, revenue 60% would be up around 18 million. As you can see, the total beds are 440 beds and EBITDA would be 3.6 million. This gross margin is on a percentage basis is lower because this is a Medicaid business. The reimbursement rates are much lower, but when you have volume, it's still a great business and contributes to greatly to the bottom line. So this is the balance sheet at the end of 2023. There's been changes to that, but this is important to look at, and it's important for everybody to look at when you're looking at our company. We've dramatically decreased debt over the last few years. We currently have some remaining debt. If you look under the December 31st, 2023 column, you'll see under related payables, there's $2,572,000 in debt. $2 million of that has now been converted to equity as of about a week ago. So we're slowly decreasing the debt down to the point where we will qualify for an uplisting to the NYSE. We would qualify under Standard 1 because we have the income. We have meet all the other factors except for 2, which is the stockholders' equity, which will reach once we raise more equity and convert more debt. And of course, a minimum price of $3 would have to be achieved through a reverse split or a stock consolidation. We do plan to do that at the time when we're ready to uplist. So there's 3 ways to invest in the company now. We're trading on the OTC, you can buy in the open market. We do have a registered Reg A+, which you can contact the company about. Typically this would be for a higher level of investment. And then there's a preferred share that we're setting up for larger investors, and that would be, a 6% preferred, which I'll show you the terms of in a second. The use of proceeds, $500,000 expansion. That means the Florida operation and the new location in Boca. We shouldn't really need any of that because it's all paid for so far. But it's there for budgeting purposes. 1.5 million would go to paying back the bridge loans, and $1 million for the acquisition, which would be funding that we can use in Kentucky for operations there. Next steps for this. Sorry, I missed one slide here, which is the preferred share. The convertible preferred at 6%. Would be done through a Reg D, so it's a 6-month hold. The conversion would happen after 6 months and after it's uplisted to a major exchange, and the conversion value to be negotiated based on those factors, but we have a pretty good idea of what we're willing to do with investors on that. So just to sum up, next steps, it's a growing market demand. It's a recession-proof business. We have experience in operating. It's fast growing, great valuation at this level, incredible valuation, and flexible investment choices. So this is why invest, based on what we have in the company now. The Kentucky company, although we're managing it, we will close on it as soon as we can get the legals and the documentation done to complete that. At 60% capacity, we reached 31 million in revenue and EBITDA of 9. If we're at 80% capacity, it's as high as 41 million and a much higher EBITDA because it's getting, you're getting more margin as you increase your revenue. So that's it. I'm going to stop there and open the floor to questions, Anna.
All right, great. Thank you, Shawn. We do have some questions for you. Sloan asks, are you solely in Florida and Kentucky? Explain exactly where you are and talk a little bit about your growth areas. What are some new areas you're going to be expanding into?
So we've always said that we were going to concentrate on Florida and the Southeast. I don't know if you consider Kentucky to be Southeast, but it's certainly in the area that we were considering expanding. So we'll stick to expansion in those areas. In Kentucky, we're located in the eastern and western part of Kentucky, which is going to allow us to service 7 states. The area in the eastern part of Kentucky borders on Ohio and West Virginia. And in the western part of Kentucky, you have Illinois, Indiana, and Tennessee. So we can service Medicaid employees. There's some licensing and things to do that, but we can service 7 states from the locations in Kentucky. So we're satisfied with what we have in Kentucky and serving that section. We may look at the Carolinas as another place of expansion, but first we're going to, take on this large expansion in Kentucky before we look anywhere else. And in Florida, we're in West Palm Beach and Boca Raton. We would consider other locations in probably Orlando and or Tampa.
And Tyler wants you to talk a little bit about what insurance covers and what it doesn't cover. Specifically, does it cover your stay at the treatment centers?
So the insurance in our industry is set up on a per diem. So when you have a client and there's different levels of care, there's per diem rates that are all inclusive for the client's stay. Medicaid is a little different. It does have per diems, but it has extra charges for things like medical services and pharmacy services and things like that. We have different rates with different insurers, but we are in network. So we're under contract with about 12 insurers in Florida. We'll expand that to Kentucky, and we're in Medicaid in Kentucky, but not in Florida, and we'll look at Medicaid in Florida.
And Balin asks, are all of the buildings and spaces leased? And when you say you're leveraging Florida, is Florida owned?
So Florida, the facility in West Palm Beach, we did purchase it, but we immediately sold it to a sale leaseback fund. So it's leased. We don't own it, but we have it locked up for the next 40 years under lease. And the Boca Raton location is also a lease. It's owned by a medical group of doctors, and they don't have any intention of selling. In Kentucky, we lease 4 of the 22 facilities, and there's ownership of, 14 of them are owned and 4 are leased. We don't know long term whether we'll continue to own the properties or we'll do something similar to what we did in Florida, which is to bring in a fund to partner with us, which really would generate cash for the company initially. It would just be a little bit more expensive to operate on an annual basis going forward.
And Jaden asks, what does your staff look like at your facilities? Do you keep doctors and nurses on staff? Do you have counselors?
Yeah, we're fully staffed by physicians, ARMPs, nurses. They are different levels of treatment. The early stage of treatment is detox, which is heavily staffed by medical professionals. And as you go further down the trail of services from residential detox to residential to intensive outpatient to outpatient, you get less and less medical involvement, but they are involved all the way through anyone's stay with us in the facilities.
And Emery wants to know, where are your patients from? Are they local? Do they come from far away?
So we traditionally have not been doing any marketing in Florida. In the past, facilities in Florida and other parts of the country, such as California or Texas or Arizona, would market to northern states for people to come south and go to treatment in the south. We really don't do have not up until now done any marketing. So we just take what's in our local community. It's the same thing in Kentucky. It's just local clients that they service. We have, because we're adding Boca, started to do some PPC advertising in Florida, but we're targeted only in Florida. We don't target outside of the state. So we stick to servicing local people in the state that we're operating in.
And Cameron wants to know, what's your vacancy rate? What percentage is vacant on average?
So we, it's very, very, in my opinion, there's no such thing as 100% because of the way clients turn over and the unpredictability of, the availability of beds. And now he's having to make sure that you try and have a bed. So 80% is like 100%. It's hard to operate in the 90s or higher than that. And that means 80% of all of the available beds. We do very well at 60% occupancy. And I would say that we generally float between 60 and 80% occupancy.
Fantastic. And a question from Julia: are there options in the area? Other options in the area for treatment? Who are your competitors?
Well, there's 17,000 treatment centers in the United States. So,
sure.
We have competitors everywhere. There's a huge market, and there's no lack of competition. We don't view other facilities as competitors. We look at them as other options. Sometimes a client doesn't work at one facility or another, it's just not for them. And we just as soon see them treated by another facility as opposed to not getting any treatment at all. So there's a lot of referrals back and forth between different companies that are in the business. So it's again, there's a big market. We don't view it as competition as much as, other people providing a service. But there's plenty of them in both markets that we're in.
And with referrals, do doctors and insurance, do they help with the referral system?
Yeah, I mean, it's really a lot of it is based on reputation, word of mouth. But we get a lot of people from the insurance companies. So if you have a policy, you go on the insurance company's website and you say, where can I go for addiction treatment? It'll list us because we're in network or we're under contract with them. Medicaid, for example, in Kentucky, there's a lot of people that might come from, the court systems or, the drug courts, for example. A judge will call up and have his staff call us and say, hey, we've got a guy that, we can send him to treatment or we can send him to jail. If you guys are willing to take him, we're going to refer him to you. So that person would come to us and they would be mandated. So it would either they're staying with us or they're in jail. So, we do very well with clients like that. The insurance companies refer, other facilities refer, medical personnel refer, EMTs refer. So it's a wide variety of referrals, but it is pretty much entirely referral business, or large part. People just looking on the website for an addiction treatment center certainly exists. It's part of our marketing, but we tend to be more referral based than just internet location.
And Dee asks, what does the bed growth look like through December of 2026? You mentioned a goal for 2025. So is that still on track?
So the goal for 2025 is, essentially it's met. We really just have to integrate it and work through it. So I'm really careful to not say, hey, now we're going to get to 1,000 beds in 2025. We really, even though this was our growth path for the next, 18 months, and it's been brought forward, we'll look at growing beyond that, after we're comfortable with what we've acquired and that we're running properly and effectively in the beds that we have. But, probably the next target will be 1,000 beds, whether that'll be in mid 2025 or sometime in 2026, a little bit too early to say this event with the Kentucky beds and the opportunity that we have here came up quickly and, it far exceeded what we were expecting to grow by. So, all I can say is there'll be more growth and we'll know more about when and where as we develop this opportunity in Kentucky.
And last question from Ishan. At the time of the uplist, do you anticipate any convertible debt that could be considered toxic? Could it be wiped out?
No, we have no convertible. We have no variable rate debt. There is one small note that we have in the books that comes due in August, and it's, even though it's got it's a known friendly shareholder of the company, and that we expect to pay out and pay off and not convert. But other than that, there's no more convertible variable rate debt. I know that we had a legacy of that from we had some troubles back in 2019, 2020, but that's all been eliminated. And so anything that we convert would be at, an agreement, an agreed upon price. I don't expect to convert or issue any equity, anything lower than what our current Reg A price is, which is 0.0012. We, in fact, after this Kentucky, are looking at moving that price up. We have far more projected revenue and EBITDA in the company than we did just a week ago. It's dramatically increased. So we'll look very carefully at what we issue anything at, but we don't expect to see any issuance of equity at lower than those prices.
All right. Well, thank you so much, Shawn, for your time and presentation and important work you're doing. We appreciate you and hope you come back in the future with some updates.
All right. Thanks very much, Anna. Thanks, everyone.
All right, everyone, stay with us. We'll be right back with our next presentation.